Hi, everyone. This is Jason Birako of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest, Louis Cammarosano of Smaulgld. That's Smaulgld. Louis, thank you for joining me again.
Jason, thanks for having me. It's wonderful to be here. And congratulations on the growth of your YouTube channel.
Thank you. Yeah, I'm really happy. It's finally starting to take off. Things are really starting to compound and grow. It took a lot longer than I thought, but it's been worth it.
All right. Congratulations.
Okay, Louis, well, I want to ask you about your opinion of the dollar index. You've told me in the past in our conversations, whether they've been recorded or we've just, talked off air, that you think the Federal Reserve pays close attention to the dollar index. Why do you think they do that?
They do that they do it for two reasons. They do it in order to be able to plan what they want to do. So they need to have the dollar index at certain levels. And then if the dollar index is going in a direction they don't want it to go, they then have to intervene. And the way they intervene, and they do it all in short term. If you think about how Wall Street thinks, Jason, everything is short term. So they know they're going to get, if they have a long-term plan, all they have to do is a series of short-term statements to get people just to do exactly or get markets to behave they want. So for example, if you start back in 2009, and they had come out and said, oh, here's what our long-term plan is. We're going to print $4.5 trillion over the next 6 years. We're going to take interest rates down to zero. We're going to leave them there. We're going to buy all the mortgage-backed securities, $2 trillion worth of those off of the too big to fail banks. We're going to buy 70–80% of the newly issued U.S. Treasuries to the tune of $2.5 trillion. The dollar would have collapsed. If they'd come out and said, that's what we're going to do the next 6 years, it would have collapsed. However, that is exactly what they did, Jason, and the dollar index came out stronger. But during that period of time when they were doing it, they didn't just do that. They did QE1, and then when the dollar index fell, they started talking about stopping it, and they did exactly the same thing with each successive QE. As the dollar fell, they decided, okay, that's enough. We can't get away with any more QE. Dollar index has gone down. They stop, and then the dollar index goes back up. But the real coup that they pulled off was QE3. When they did QE3, I think you, myself, and just about everyone else thought, that's it. The dollar is going to tank, and gold and silver, which were already elevated and had been rising since 2009, were just going to take off to the moon. And what happened? That didn't happen. That's when gold and silver fell through a lot of naked short selling. We can talk about that. That drove that down. But QE3 actually did not harm the dollar at all. The dollar rose, and it continued to rise when they kept saying, we are going to taper it. We're going to taper it. Meanwhile, they're printing money like mad, recklessly, and yet they're not destroying the dollar because people believe them that they're eventually going to stop this. They're going to taper it, and they're going to raise rates. If you remember, that's all they did. Now the dollar index, when they exited QE3, the dollar index was higher than it was in 2008, 2009. And by the end of 2014, it was at multi-decade highs. It was up towards 100. Okay. Now, had they said when they were tapering QE3, we are when QE3 ends, we're just going to talk about interest rates for a couple of years, and by 2016, we might have done a quarter of a rate hike. The dollar index would never have gone from 78 to 100. The only reason the dollar index went from 78 to 100 was because they kept telling people, oh yeah, we're going to raise rates. Oh yeah, we're going to raise rates. And that drove the dollar index up. Now they've had a problem, Jason, since 2015. They've managed to keep it up during that time period. But entering into 2016, it became clear, wait a minute, we went a whole year, 2015, without a rate hike, other than that one they did at the end of December. Then the dollar started to fall. The dollar index went from 100 down to 98, 97, 96. And that was around May. And that because they had kind of indicated, well, we're going to do 4 interest rate hikes this year. Oh, no, maybe we'll only do 2. Maybe because of Brexit, they started to backpedal to the point where it seemed like markets were discounting that they would ever do any rate hike this year. And that's when I had what you call the first Fed yak attack. That's when you had most of them non-voting members of the Fed coming out and saying, June rate hikes are on the table. June rate hikes are on the table. We might do a rate hike in June. And of course, June comes and goes, and there's no rate hike, and they blame Brexit. Then, Brexit happened after the June meeting. Then July comes, no rate hike. And now the markets start to think, wait a minute, we're not going to have rate hikes this year. And the dollar index last Monday night fell from like 96 something all the way down to like almost 94. And what on cue, what happens? Fed President Dudley comes out, Fed President Lockhart, Williams. We might do 2 rate hikes this year. We might do a rate hike September. Yeah, September. We're going to do rate hikes. Now you see what they're and the problem that happened this time was the dollar index kind of responded immediately, but it's given up most of those gains. So now everybody's going to be looking to Janet Yellen on Friday to see what she has to say. But the reason I mention all of this is they want to have the dollar index at a point where it's high enough so that if they want to do more QE, it can be sustained, because if the impact is going to be that the dollar index will fall when they do QE, they want to keep that dollar index high. And right now, the dollar index is very high. They don't want it too high for purposes of exports and it gets too expensive, but they also know they cannot start another QE with the dollar index down in the 80s. So they purposely do these yak attacks when they see the dollar index falling. And the way they boost the dollar was through the assault of talking about interest rates. The problem they run into, though, Jason, is that they're at a point where it is like the boy who cried wolf. They've been talking rate hikes. And if anybody is not looking, just listening to what they're saying and thinking about next week, but has gone back and just kind of looked at what's happened, you realize the Fed has basically just been talking rate hike for 3 years and they've done a quarter point. But they've gotten so much mileage out of that. They managed to get away with the largest QE ever, the last one, QE3, and they managed to drive the dollar index all the way up to 100 on the basis that somehow they were going to normalize rates. Basically, what they said in 2014, by now, this year, end of this year, they might have done 6 to 8 rate hikes. No one remembers that. They've done one. They might do one more if the dollar index falls further and people start to say, wait a minute, you guys are never going to raise rates.
To people like me, Lewis, and you, talk is really cheap. But I guess to people on Wall Street, they still have given the Federal Reserve a lot of credibility that, oh, it's just being delayed. It's data dependent. Oh, they'll eventually raise interest rates. I think a lot of Wall Street actually bought in after 2009 that the economy was actually starting to recover,
Yes.
especially from 2011 to 2014, early 2015, that there was a recovery there. So a lot of people sold their gold and silver. A lot of people bought into U.S. stocks again. There was also, I would add, a lot of other money coming into the U.S. from emerging markets. One of the reasons the dollar index has done so well is that other markets, especially emerging markets during that time, there was a commodities bear market. They had borrowed over $10 trillion in U.S. dollars, and their own currencies were falling. So the dollar, on a relative basis, it was the cleanest dirty shirt in the laundry basket, I guess you could say, compared to, you could pick your analogy, compared to so many of the other countries in the global economy and these other emerging market currencies.
I agree. And that's what they wanted. Remember, gold and silver are the enemies of fiat currency. And they purposely, people like you and me, I wrote in May of 2015 that the Fed would raise rates. We had a lot of people say they would never raise rates, but the markets believed they were going to raise rates. But at the end of 2015, when they raised them, there were 2 camps. People say they'll never raise them again. And there were other camps saying, well, now they're going to start normalizing rates. What I said back at the end of 2015 is they'll continue to push the concept that they're on this rate hike path, data dependent, of course, because the economy is improving and the job gains are going to lead to economic growth. You're hearing that story now. I mean, they work hand in glove with the Wall Street Journal, Reuters, AP to produce that narrative that somehow growth is just around the corner. And they like to point to the strength in the labor market, which is all manufactured, and that the stock market is doing well. Those are kind of how the housing prices are higher. Those are the 3 stools of the economic propaganda stool. The 3 legs of the economic propaganda stool, where they try to tell you the economy's fine because the stock market's doing well, because real estate's doing well, and somehow we have all these part-time jobs. But I knew that what they would do, would they be talking about a rate hike, not talking about a rate hike for months, all these conflicting signals, these yak attacks, but then do nothing other than maybe, if their bluff is called, do one this year. And we look at it and say, like you say, we say they're losing control. They don't know what they're doing. We think that. The market doesn't care. They're not thinking of this, in a macro sense. They're just thinking, what's the next trade? What's the Fed going to do? And they start to take bets on the next move, not in where we're going to be in a year or 2 years or 3 years. Where were we the last 3 years? Like, what's going to happen next week if the Fed says something? What happens when the Fed says something tomorrow morning? And that's how they manage to keep their control. Not only just by talking, but then by, of course, their policies, Jason, which have zero interest rates. You've got Bank of Japan owning 20% of the top, being the #1 owner in 20% of the Nikkei 225. Swiss National Bank buying equity shares in the U.S. Who knows what they buy elsewhere? I mean, central banks are so embedded in these markets. And, you talk about Austrian School of Economics, interventionism. This is more than interventionism. This isn't just setting rates too low. This is actually working with the media to create a narrative exactly how they want things to go. And then actually intervening, ECB buying corporate bonds. It's basically more than even price fixing. It's actually they go in and they become the market. And that's the real scary thing about this whole thing, is that they are so involved in the markets that it's harder for them to lose control. If there were free markets, you could say, well, eventually the free markets will take over. Not that they can just print money and buy whatever they want and set.
Yeah.
That's the real danger here.
Yeah, this is dystopian, Lewis. This is a Twilight Zone. We are at the full perversions of Ben Bernanke's 2002 helicopter speech. And you told me before we started recording, when Ben Bernanke was saying all the stuff in that speech at that time, I think it was 2002, fast forward to today, but back then that would have been science fiction, all the stuff he said.
Buying corporate bonds would have been science fiction by a central bank. A foreign central bank buying U.S. equities would have been science fiction. 3 rounds of QE would have been science fiction. Now, every central bank views quantitative easing in massive amounts is not shocking. That's just normal policy. If we have a problem again, you just do quantitative easing. What is that? Well, you print up money and you buy assets. It used to be you bought the specific troubled assets. That was the first QE, and sovereign bonds. No, that's not enough now. Now, QE means for Europe, you can buy corporate bonds, at least in the those that are in the Eurozone, but why not buy other corporate bonds? And then, of course, in Japan, it means just dig in and push up the Nikkei, buy whatever stocks you want to buy there. And
yeah, look,
that's the real danger, is that the central banks are involved in markets where originally a central bank, as you know, Jason, is supposed to be just the bank of last resort. If the other banks are having trouble, they provide those banks with liquidity. They're not supposed to have a mandate to drive the labor market or to push the stock market higher. But this all started back with Greenspan, right, in '87, where they created the plunge protection team, and they decided we have to have confidence in the markets, and if the Fed can provide liquidity, they're going to become part of the market.
Yeah, and what's to stop the central banks then, especially the Federal Reserve, from buying up all the over $1 trillion in student loan debt that's in default, or the subprime auto loan debt? So, I mean, this can go on for a while until maybe the dollar loses its sole world reserve currency status. It's really tough to say how long this can go on. I mean, a lot of smart people have tried to give an exact date, an exact prediction for when this would end, but the central banks keep coming up with new, all these different programs for liquidity injections, whether it's overt and direct, quantitative easing. Like you said, we're over $180 billion per month in collective global quantitative easing. And that's just from the Bank of Japan and the European Central Bank. That's not even counting whatever China's doing. It's not counting any of the interest payments that the Federal Reserve is reinvesting from the over $4 trillion in assets on its balance sheet. So, and then you go to the covert part, where the central banks have these off-balance sheet currency swaps that they're not even counting as liquidity injections, because they say these are hedged positions and things like that. So they can inject these are no interest loans and emergency liquidity, blah blah blah. So the lack of transparency, when we get a PR statement that comes out from a central bank, we don't know what they're doing behind the scenes. Once in a while we find out some news stories here or there, but the PR stories we are getting, Lewis, it's just insane, the amount of liquidity that they're putting in. Do you think then they're totally panicked then about letting asset prices fall at this
Oh,
point?
absolutely. And the other point, Jason, is not only are each of these banks doing it in most extreme ways, more than we've ever seen before, they actually coordinate it. So back when we had currency wars in the 20s and 30s, those countries like France was against England. You know, they weren't allies. Japan wasn't working with France. Today with the ECB, the United States, the ECB and Japan directly coordinate monetary policy. It was no surprise that when the US ended QE and the QE3 that Japan started its right away. It's no surprise that Stanley Fischer and Mario Draghi are buddies and that Fischer told Draghi when to start QE in Europe. So the fact that they're all doing it compounds the issue, and they do it in a coordinated fashion, which really makes it like there's no exit from this whole thing. And then you got Russia off to the side, but their central bank, it's got $370 billion worth of assets. It's really not that eh, much of an issue in the global markets. Now, China is the People's Bank of China, but they're part of the SDR. They're part of this whole game too. They got one foot in the game, one foot out of it, but they're not doing anything to disrupt. They're just keeping an eye on their U.S. Treasury bond holdings and make sure that they maintain their value. But there really are no currency wars in the sense that they're working against each other. They're all working with each other because they all know that all their currencies are fiat based and no one has an advantage over the other. And they all seem to be just agreeing to print whatever they need to print to keep equity prices high and to keep interest rates low so they can continue to fund their own government's massive debts because all the governments have debts that they can never pay.
I think the currency wars, there are currency blocks, like you said, with coordination, but I think it's more the developed world against the emerging markets
Correct.
for the most part. Yeah, so if there is a currency war, it's the United States, England, ECB, the European Union, and Japan
Correct.
against the emerging market countries. So that's how I would describe the currency war. But yeah, I think a
With
lot of
hold
these
on, but with
central,
China as half an ally though.
yeah, China's hedging its
China is
bets. Yeah,
not like leading the BRICS. In other words, if Brazil gets screwed, it's no skin off of China's nose. They don't want, in other words, the emerging markets that don't have China's clout are getting crushed by
yeah, I
by
would
this
definitely
central
agree.
bank coordination, ECB, Japan, US, Bank of England, Bank of
Yeah, I
Switzerland
agree.
too.
Yeah, I would agree with that. I think like the U.S., the Federal Reserve, and Bank of Japan, they have the largest amounts of debt outstanding, debt to GDP, in terms of size of debt. I think both of those guys are trapped. They've gone to financial repression. They've taken interest rates down so they can increase the amount of government borrowing, and their interest payments on the debt are actually lower than they were a decade or two ago because they manipulated interest rates lower. We've gotten to that negative interest rate territory now where whether it's the central bank discussing implementing negative interest rates and charging the large investment banks to keep money there docked at the central bank, or it's the individual large banks discussing whether or not to charge depositors money to keep money at the bank. This is, I think, one of the reasons why the gold bull market restarted. Before we talk about the gold bull market, though, why do you think gold had a paper bear market from 2011 to late 2015?
Well, it is kind of odd because there was negative sentiment. Well, first of all, I believe that there was manipulation, that the gold price was going straight up, so was silver from 2009 to 2011. And that had to be stopped. And of course, when you have those massive short selling raids, it reduces sentiment. So, unless you're a purist and you want to fight the cartel, you're not going to basically try to think that you're going to go long when everyone's selling. But what happened during that time period from 2011 to 2015, you saw massive physical demand coming out of China. The Shanghai Gold Exchange had, I think, 3 years in a row over 2,000 tons withdrawn from the Shanghai Gold Exchange. It reached its peak last year at like 2,600 tons. You had massive imports despite the duties in India. You had massive silver imports during this time period. So as you and I have discussed, you generally think sometimes of gold and silver as a giffen good, but I actually view it when it's on sale, the Eastern physical buying went nuts. And that was something that didn't exist, 20, 30 years ago. There just wasn't the amount of money to pick up that physical demand slack as there is now because China and India are the number one and number two, depending on the year, gold consumers, and India is a massive silver consumer as well. So the last 3 or 4 years, you've seen massive silver and gold demand physically, and the price went down. And you also see in the United States, the silver coin demand has gone from next to nothing to a percentage of the overall silver demand. So in 2005, silver coin and bar demand, meaning sovereign coins and then your privately minted rounds and bars, were only 5% of the overall 850 million ounces produced each year, or mined each year. And now they're close to 2025 because, especially in the last 3 years, the US Mint has sold 40 million plus the last 3 years. Canadian Mint sold 40 million last year. So you saw when the price went down, but sentiment was down, but physical buying was up. So I think there's a kind of divergence there. Now this year, sentiment is up. Physical buying is down in Asia, down significantly in China. Shanghai Gold Exchange is down 25% on withdrawals. Indian gold imports are down 40%. But Western investment demand is massively up when you have record amounts of dollars and supposedly physical metal pushing into gold and silver ETFs. So the investment demand is up, but when the investment demand goes up and the price rises, then the physical demand goes down. And we're seeing that in the Eastern demand, and also recently in the last couple of months in the coin sales in the US and the Perth Mint and other Western mints.
Yeah, you mentioned Giffen Good. I think gold and silver are only Giffen Goods in the West, where people are more myopic and short-term oriented. The managed money, a lot of guys on Main Street who don't have a lot of financial market experience or not familiar with gold and silver, they'll chase the price higher. They'll chase the paper price higher. But I think, the Swiss refiners, a lot of physical gold now is starting to go to London, whereas in the past, 3 or 4 years during the paper bear market, a lot of that physical gold, it only went to India, it only went to China for the Shanghai Gold Exchange or Hong Kong, and it only went to Russia for the Russian Central Bank. Those were the three main buyers, I think, in the East. Now it seems there's more competition for the physical gold, more out of London and the West, now that the paper price is doing good. Although a lot of the managed money, Lewis, on Wall Street, the billionaire money managers, they can't buy any physical gold. So I think those guys are going to end up in the mining stocks, and those guys are going to create we've already had a nice move in the gold and silver miners since the end of last year, but I think, that's just getting started because, on dips, a lot of these guys, the managed money, are going to be accumulating big positions.
So if you look at managed money in the West, their investment mandates don't say go out and buy blocks of gold and store it in a vault over here. They're allowed to buy stocks. They can buy not stocks, but things traded entities. They can buy GLD, they can buy SLV, they can buy mining, gold and silver mining shares, they can buy futures contracts. That's what Westerners buy. And you're right, when the price goes up, they buy that. Indians who have 5,000 year history of buying gold, they don't go out and buy it when the price is rising. They know it's not going anywhere. They buy it when it's cheap, and they buy a lot of it when it's cheap. When the price goes up, they stop buying as much of it. And that's what China did this year. And also, people don't realize is that up until this year, for the first time in the first half of this year, investment demand actually was greater than the non-investment or the jewelry demand. So if you think about jewelry, there's no way people are lining up in jewelry shop. Chinese housewives or Indians out in the middle of a farm somewhere are going to have massive demand for gold that's gone up 30, 40%. It's just not going to happen. But as you say, the Westerners who been trained in these stock markets to chase things that are going up, they'll chase Tesla, they'll chase anything. That's why I think, as you say, Jason, there's probably going to be a mania in these mining shares. Anything that was .com went up. I think at some point, if this continues, anything that has the word mine in it is going to go up, just because fund managers need to find something that isn't massively overvalued like every other stock, and something that's actually just going up. Could be going up for whatever reason. They don't care, or they won't care. They'll just buy because it's mining and it looks like the chart looks good. That's the difference between a physical market and these paper markets.
Now, Lewis, I want to ask you about why the gold and silver bull market restarted. Do you think it was mostly because of negative interest rates being implemented all over the globe, or do you think that was one of the factors and there's a bunch of reasons why the gold and silver bull market restarted?
One of the problems I have with Reuters and Bloomberg and all these outlets, I was reading for years stories about anytime they wrote about gold, they always threw this cut, and gold doesn't pay interest, and that's why it's not any good. That was always like that. It's not supposed to pay interest. Okay. But I used to always write to them and tell them, but a lot of bonds, even now in 2015, weren't paying interest. It's really a stupid argument to say gold doesn't pay interest. But that became apparent as there became more and more stories. And actually, Bloomberg started to mention the fact that, well, hold on a minute. A good percentage of bonds don't pay interest. So now where are we? And we had a lot of talk about negative interest rates. But you also had at the beginning of the year a lot of this Brexit talk. You had uncertainty, and the stock market was viewed as overvalued. And when the stock market fell, Western traders said, "Well, wait a minute, let's go for the asset that didn't fall and that's been depressed for 3 or 4 years." So they bought gold. So I think it's a function of, if you look the last 3 years, the East was buying gold because it was cheap, and they kept buying it and buying it. And as they were buying it, the price didn't go up at all. It went down even further. It wasn't until the Western traders decided, hey, we've seen stocks rise for 5 years. How much further can they go? I mean, how much higher can they go with earnings flat? Maybe we can buy something like gold mining shares or gold ETF, and maybe we got a shot to get some motion on that. So I think that's what started the momentum. I don't It wasn't because people woke up at the beginning of the year and poured their money into physical metals. It was because the Western traders moved in and decided that these assets, gold and silver, especially gold, are at a point where they're attractive just based on where they are compared to the rest of the market. And if you look at gold mining shares, Jason, gold mining shares are still far undervalued historically vis-a-vis their price versus the metal price. And
I
they see that too.
I also think, Lewis, that when we got to towards the end of last year, when we got to 1075 gold and we got to around $13 silver, the demand in the physical markets were strong. The East was buying. But the supply side, the miners, the primary gold and silver miners, and the base metal producers that produce silver as a byproduct, they were hurting just really, really badly. And we had gotten to the point, especially for the primary gold and silver miners, where they could not raise any more
Right.
capital. They were cutting costs as fast as they could. They were high grading their mines. They were coming up with any way they could to cut costs as fast as they could, just to buy themselves, another month or 2 months, and hopefully not go bankrupt and hopefully survive the bottom and the cycle turning. And we got to that point. I had been saying I was a little bit early when the bottom was in, but I was like, we're around that point where I was talking with my mining contacts. They can't raise any more money. They've been cutting costs for 3 or 4 years as much as they can. They can't cut any more costs without shutting down the mines. So something had to give very soon. So I knew we were very close to a bottom, or all the mining industry was going to go bankrupt and all the people that needed the metal wouldn't be able to get the
Right.
metal. So I thought that's why we were close to a bottom at that
And
point.
you and I we did a podcast, I think it was in September, October last year. We talked about that. I think it was entitled Silver Miners, Increasing Output Until Bankruptcy. Because in 2015, even with it being uneconomical to mine silver, silver mining increased in 2015. And we thought, wow, that's counterintuitive, but it's because they had to in order to meet their debt obligations. But the other thing that's interesting, and I didn't know this at the time, I don't think many people did, but for example, the Swiss National Bank had been buying gold and silver mining shares. They had $500 million worth of them at the end of 2013. They had been buying these shares as the prices were going down and reaching these ridiculous lows that they reached at the end of last year. So it almost seems as if the managed money had an interest in higher gold and silver prices to support the mining shares that they had accumulated at these rock bottom prices. And then, of course, if the price of gold and silver rises, the mines, the ones that are operating, don't necessarily need an equity infusion. They now can mine profitably based on a 30, 40, 50% increase in the product that they're selling. So, there could be a lot of that organized managed money that had been buying the mining shares low, unbeknown to us, that had an interest then also in boosting the price of the metals underlying those gold and silver mining shares.
Yeah, that's a great point. Now, the Swiss National Bank, which is the Swiss central bank, they now have over $1 billion worth of gold and silver stocks, right? But in terms of the miners, I think the gold and silver companies now, if they've cut their costs and they don't start producing, uneconomic ore, marginal grade ore that increases their costs, if they can keep their costs relatively stable, if the oil price doesn't rise too much, these guys have a real good sweet spot
Yes.
for gold and silver right now. So they have a nice window here, provided that, governments don't start increasing taxes on mining and the oil and diesel prices don't go up too much.
And it doesn't appear that, that even though gold and silver and oil kind of tracked each other from January to June in the sense that they went up, the fundamentals for oil are not the same as gold and silver. I mean, the supply demand dynamic for oil is basically they're at massive amounts of overproduction and the demand isn't skyrocketing. Whereas with gold and silver, you do see at least the investment demand increase, and you have not seen any major increase in the mining to cover the physical demand. So gold and silver, and I think just on a supply demand basis, in far better shape than the oil. And so I don't expect oil to go up another 20, 30%, whereas you can see a scenario where gold and silver do that. They may not. I mean, of course, if they get smacked down again, they won't. But the fundamentals support gold and silver prices far more than they support higher oil prices. And
Yeah, I agree. Not unless the paper oil market can be manipulated higher by either OPEC or the Wall Street banks, because the Wall Street banks don't want to default on the shale oil
yes,
companies. Remember, we saw that. So I think obviously there's not as much paper in the oil market as there is in paper, gold, and silver futures contracts, but the oil market does have a lot of paper barrels of oil out there that allow them to play games. Not quite as much. Now, Lewis, we are at $2.15 per pound copper. So that's an interesting copper price. If copper price gets to $2, if it keeps going lower, maybe breaks $2 for 6 months or a year, that's going to be good for silver, don't you think, long term?
that's going to be good for silver to the extent for our listeners that only 15%, I think, of silver that's mined each year comes from primary silver mines. The rest comes as a byproduct of copper, zinc, and so on. So, yes, if copper demand and copper prices are down, and you're right, they're at, I guess it was, I mean, copper prices have been cut in half in the last 5 years. And if there's less copper mining going on, then there'll be less silver being produced as a result. So far, we haven't seen it. As I mentioned, silver mining production was up in 2015. There were projections at the beginning of this year that silver mining would be down 8-10% this year. A lot of the silver miners still are producing. The same thing could happen in the copper mining industry too, where
Yeah,
where there's a concerted effort to kind of boost the copper price just to keep them going.
Yeah, a lot of the copper miners don't really care about their silver byproduct and the price of it. So, if they have extra, if they have to, they'll sell it as a byproduct in a silver stream, maybe to Silver Wheaton or Franco Nevada,
Right.
or they'll hedge it. There's a lot of hedging. So we might have seen hedging for years now on the silver, and that's why the silver production, another reason why the silver production hasn't fallen yet, is because these copper miners that produce silver as a byproduct, they have to keep producing the silver because they've hedged it out for years at their mine.
Hmm.
Well, now, Lewis, I want to ask you about Alan Greenspan. Alan Greenspan is warning about inflation. Maybe now that he's outside of the Federal Reserve, he's going to be more honest. And he's been also telling people to buy gold.
Yes.
Why do you think he's doing that? Why do you think he's being honest all of a sudden?
I think, if you go back, if you understand Alan Greenspan's history, he was an Ayn Rand acolyte. He followed her and he wrote what Golden Freedom in 1966, where he said basically the only thing standing between, these reckless governments printing money is gold. And he fully understood that gold acted as a bulwark against reckless monetary and fiscal policies. Then, of course, he becomes the Federal Reserve chairman. And within months of his appointment in 1987, the stock market crashes. Now, you would think free market, Ayn Rand principles would say, well, that's nice, that's good. The stock market crashed and it'll clear out the bad investment and it'll reprice itself and it'll be fine. Alan Greenspan, however, also realized, though, that one of the main advantages the United States had, besides the dollar as a reserve currency, was that it had that stock market, and that it was the world's envy. It was the place where most of the world's capital went to buy equities. So he decided that the Federal Reserve was going to stand ready with as much liquidity as it needed to kind of boost the markets. And that's when the plunge protection team, the president's working group on, I don't remember the name of it, but the short term is plunge protection team, uh, decided they were going to intervene in the market and make sure that the market didn't crash. And so Alan Greenspan decided there's one thing to have philosophical views on markets, and there's another thing to be the guy who's in charge of handling a position of power, where in order for him to maintain his power, he went outside of his authority. It's kind of like Thomas Jefferson was talking about limited government. Just quick history lesson. In 1803, without asking Congress, he just writes a check to France for the Louisiana Purchase. You know, that's not consistent with small government principles. It's the same thing with Greenspan. Anybody goes into power. I mean, who knows what Ron Paul might have done if he'd become president? You know, you think
they won't allow him to be
no,
president.
I know, but my point is that anybody who has power, even if they're not power hungry to begin with, if they're given it, I mean, Alan Greenspan got caught up in it. He was the maestro. He had led the country through without even a blip in the stock market in 1987, the last stock market, supposedly the crash. This is superficial history, but the last stock market crash like that in 1929 led to the Great Depression. Nothing happened after the 87 because of Greenspan. Greenspan led us through the golden eras of the internet bubble. 96, he talked about irrational exuberance, but that was about it. I mean, he basically played along with the stock market needs to be preserved. And then, of course, he created the housing bubble by pushing interest rates low after 9/11.
Yeah, there's a lot of inflation in asset prices. There's inflation on Main Street in terms of healthcare, in terms of food prices, in terms of education costs and rent, and utilities. So all the basics people need to survive that most people would spend their money on every day. These prices, for the most part, are going up. And then you add in the layering of taxes. So I just read the paper by John Williams, who's not John Williams, the Shadow Stats, the other John
the
Williams.
San Francisco Fed president. Yes.
Yes, and he's talking about how there's too much deflation and we need to start inflation targeting. So it's just crazy that these central bankers want even more inflation going.
Hold on. I just want to make a quick point about John Williams.
Sure.
He's out there yakking rate hikes, but then he puts out a paper talking about how we can't have because rate hikes would lead to pulling inflation down. So you see this yak attack stuff that
right?
it shows that the yak attack is just talk. They're thrown out there on purpose. They say you go out there today and say you're going to raise rates, even though at their core these guys are negative interest rate helicopter money type people that don't want to raise rates. They want to take them into negative territory if they could, but they need to say this.
Yeah, and that's why talk is cheap. You know, I don't judge people like they're politicians now, these central bankers. They've turned into politicians where, you know, they'll go out and make all these promises and then nothing will happen. They're doing the exact opposite basically with their actions. The global financial system, Lewis, do you think then we're going to have a new global financial system or a reset or something like that in the near future then?
I don't know. I mean, the reason you need a reset is when it doesn't work. And the question is, doesn't work for whom? Right now, the central banks seem to be getting along just fine, doing reckless things that they otherwise wouldn't be able to get away with. So I don't know if I would say, yeah, have a financial reset and get rid of the central banks. But that's not what a financial reset looks like. A financial reset is going to have the input of all the central banks. And of course, right now, they're living large. They do what they want. I mean, they have free reign to say whatever. Swiss National Bank says, oh, we're going to keep the peg. Nah, forget the peg. We're not going to do that anymore. They could buy equities. I mean, they have powers that they never had before. So why would they want to reset anything?
Yeah, and if there is a reset, it would probably, as of right now, if the governments and central bankers have this much power or more power, totalitarian power, it would look more like Bretton Woods. And a lot of people think how good Bretton Woods was, but Henry Hazlitt was warning about how inflationary it was. Just like the reset before that, the gold exchange standard was, you know, not a real gold standard. It was super inflationary right after World War I.
I'm not a fan of giving central banks gold, because if you remember, when central banks had gold, you worry about manipulation now. They just fixed the price from 1934 to 1971. It was 35 bucks, and that was it. I mean, it's not when central banks monetize gold to that point, they have a vested interest, even more so, in maintaining the price, and that's why you.
Yeah, yeah, a gold standard that's monitored by a government and a central bank and manipulated at a fixed cost. Yeah, that is still market manipulation of the gold price. You're not allowing a free gold
At
price.
all.
Yeah, you're not allowing a free gold price. But at least if you can exchange your paper currency then for metal, at least the metal won't go to zero.
Yes,
That would be the
but
counter.
but
Yeah.
you could not, under Bretton Woods. You and I could not exchange our gold for any our dollars for anything. That Bretton Woods agreement was a gold standard only for the other central banks that were signatories to the Bretton Woods agreement. If they wanted to turn their dollars in that they had accumulated in foreign trade and bring them to the United States, they could get gold. But U.S. citizens haven't been able to, weren't even allowed to own gold from 1934 till December 31st, 1974. So when Nixon took the U.S. off the gold standard, that meant nothing to Americans. Americans had never seen gold, weren't even allowed to own it. That was a gold standard for central banks.
So do you think then that we could, in theory, have a gold and silver bull market keep going then as long as these central banks are doing crazy policies and intervening? There wouldn't be any stop in theory then to the gold and silver bull market because these central banks then are just hell-bent on liquidity injections, changing the names of the programs. As long as they're going to keep doing things like that, there's going to be even money managers on Wall Street now, people who would never buy gold before, who are just mainstream, value investors or bond kings, they're getting into gold and silver now. They're getting out of stocks or shorting stocks, and they're going into gold and silver stocks or physical gold and silver that they would have never done before.
What they want is, if there's going to be, and they know they cannot avoid people's desire to have gold or silver, they want them in the paper products. They want them in the gold ETF, the silver ETF, where JP Morgan, HSBC are the custodian. They do not want the people to have the gold. It's the same in India. They are trying so hard to get the Indians to give up physical gold and take those, that Indian gold monetization scheme, and take those rupee bonds in exchange for their gold. So if gold is inevitable, silver is inevitable, people are going to want it. They want them to buy gold mining shares. They want them to buy gold ETFs. If you think about what the Swiss National Bank has done, they haven't added any gold. They've only sold gold over the last 15 years. But meanwhile, the Swiss National Bank is buying gold and silver mining shares. The paper game is what they can control. The physical gold and silver is limited. They know that. They don't want people buying physical gold and silver. They can't control that. So they want people buying GLD. They don't care if someone buys GLD or SLV or COMEX contracts, because they know that all that can be financialized. It all can be put on screens. It all could be hypothecated. They don't mind that. What they mind are people buying and storing massive amounts of gold and silver, because that would highlight that there really isn't enough. Because I mentioned on a previous podcast with Rory Hall that if 1, 2, 3% of the U.S. labor force decided they were just going to save in silver, well, you'd end up, that small amount would end up being 600, 700, 800 million ounces. That's the entire global silver mining supply. Well, where's the rest of there's not enough silver for everywhere else in the world. So people can't buy gold and silver in decent amounts, but they can buy SLV and GLD and gold and silver mining shares. And you know what? I think also even gold and silver bugs are thinking to themselves, you know what? I might as well buy silver mining shares. I can make 5, 6, 7 times the increase in price that I can make off of holding silver. There are some diehards who will only hold physical metal, but they have enticed people into the paper markets because they know they can control the paper markets, whereas they can't make more gold and silver. But if they can get you into ETFs and gold and silver mining shares, they get you to play COMEX contracts. And then there's all this stuff about, someone's going to stand for delivery. People on COMEX, they want the paper profit. They've made that the main reason why people are in the metals is to get $1 of fiat profit, not to walk away with a stash for your stack. Because if you think about most financial managers, they don't call themselves stackers, right? They have a mandate, an investment mandate, to make a certain amount of fiat dollars. And it's a lot easier for them to make fiat dollars buying gold ETFs, mining shares, COMEX contracts, and so on. It's only people that are
Yeah.
really paying attention, like us, that think, well, wait a minute, that's not real money. We want the real thing. Most people don't think that way.
Well, I own both physical silver and also gold and silver stocks, and we've been buying some physical gold with our gold money account for our business. But Wall Street. That's a good point you brought up. Wall Street just doesn't make any commissions off people buying physical gold and
That's
silver.
true too.
But hmm?
That's true too.
But well, unless like they're storing it in, unless you're Morgan Stanley or another company, and you're supposedly storing metal in an allocated vault and charging them interest and fees, and then the metal's not there, it's been sold. But anyways, though, that they've settled those lawsuits, at least some of them.
But they never delivered the metal. And I heard an interview with one of the guys who was supposedly paying Morgan Stanley to hold his gold and silver, and they told him to take him a few months to get it for him. He finally just threw the towel and said, "Just give me the money." And he went out and he bought his own gold and silver and arranged his own vaulting arrangement.
Yeah, but I think the gold and silver companies, eventually they may start paying dividends out in physical gold and silver, and especially now with gold money, where it makes it easy for a business to sign up and pay out dividends and bullion to your account, and it keeps track of everyone's account online. Uh, you know, with good security features for the database, and they have storage in 5 or 6 different countries. There's going to be those available. There's going to be features like that available going forward. So I think it's an interesting time. We're in very interesting markets right now. The government's. You're a lawyer, Lewis, so you know this. Lawyers are good at changing the rules. We have an army of bureaucrats and lawyers and politicians who are mostly lawyers here in Washington, D.C. We have the same thing basically in Brussels. So these guys could eventually go for windfall profits taxes on owners of bullion. Confiscation risk is probably pretty low since most people don't actually own metal anymore. But, some of these poorer countries, maybe we've seen it in the past with increasing taxes on miners. Maybe a poorer country could potentially increase the taxes on miners, or potentially nationalization of miners. But I don't think we're at gold and silver prices right now where we have to worry about that.
No, I'd agree with that.
Okay, Lewis. Well, I really enjoy your work. You do very good research work on those articles. You broke that story about the Swiss National Bank owning gold and silver shares. That was really impressive. I didn't see anyone else even come out with that. So for our listeners out there who saw that story, Lewis broke it first. If our listeners want to find your work, how do they do so?
They go to smaulgld.com. That's where the website is. That's where all the research and breaking stories are. Or you can also visit my humble YouTube channel. It's got about 375 subscribers. It could use a few more, so please check that out as well.
I'm sure it'll get some more subscribers after this interview.
Well, thank you very much, Jason, for allowing me to come on and to expose myself to your listeners.
That didn't sound very good, Lewis.
So I was struggling to say something. There you go.
Just keep doing the research, like your article on the Swiss National Bank and the hedge fund managers at Deutsche Bank, and your content, the quality content, people will eventually find it, and you will get what you want.
All right, Jason. Well, thank you very much indeed.